All right, what's up, Tycoon? Super excited for today's video. We are going to go ahead and give you guys a quick course on Bollinger Bands, and we'll go over a few examples of, basically everything that we're speaking of, just so you can get a visual representation as well. All right, so if you find anything useful in this video, don't forget to like, comment, and subscribe. And if you have any requests, okay, whether it be a strategy, a tutorial, or you want a special ticker symbol analyzed for you, and I can give you some technical analysis, let me know in the comments below, and I'll be happy to do that for you. I do viewer request every single week, okay? So what are Bollinger Bands? They are curves drawn in and around the price structure, usually consisting of a moving average, which is the middle band, an upper band, and a lower band, that answer the question as to whether prices are high or low on a relative basis. Bollinger Bands work best when the middle band is chosen to reflect the intermediate term trend, so that trend information is combined with relative price level data. Okay. When understanding a Bollinger Bands, or on how to understand a Bollinger Bands, they consist of a center line and two price channels or bands above and below it. Okay, the center line is typically a simple moving average, and the price channels are the standard deviations of the stock being studied. The bands will expand and contract as the price action of an issue becomes volatile, and this is expansion, or becomes bound into a tight trading pattern. This is contraction. So the key takeaways, all right, are going to be the Bollinger Bands are a technical analysis tool developed by John Bollinger for generating oversold or overbought signals, right? There are three lines that compose the Bollinger Bands: a simple moving average, which is the middle band, and an upper band and the lower band. The upper and lower bands are typically two standard deviations, plus or minus, from a 20-day simple moving average, but they can be modified. Okay, you can change these settings in your trading platform that you're using. Here's the official Bollinger Band formula. If you guys are interested in it, here it is right here. Take a screenshot, pause it. You don't have to know this really to know how to use the Bollinger Bands. Okay, this is just the actual mathematical formula behind it. Okay. Bollinger Bands are a highly popular technique. Many traders believe the closer the prices move to the upper band, the more overbought the market, and the closer the prices move to the lower band, the more oversold the market. All right, and they're right. This is a really highly popular technique that many traders use, including myself, and a lot of the admins in the OTT Discord, the Options Trading Tycoons Discord. Okay, so as I said, when it approaches the top band, this is when you start to see it overbought. Okay, and then this is the bottom band here. This is oversold. All right, so we're looking at the Bollinger Bands right now, and you can see here, okay, this is your middle one, which is your moving average, and you have your top band, your lower band. All right, and as we said here, the prices move towards the upper band, the more overbought the market. Right, so we move towards the upper bands, it's getting overbought here, and then we pull back. Okay, and the closer the prices move towards the lower band, the more oversold the market. Right, so price moves here on these lower bands, it's riding the lower bands, it becomes oversold, and then it rises back up to the middle Bollinger Band, and then eventually to the top Bollinger Band, where again it becomes overbought, comes back down. So that's how they work. Okay, a very general thing is it's used to say oversold and overbought. Right, because standard deviation is a measure of volatility, when the markets become more volatile, the bands widen. During less volatile periods, the bands contract. Okay, so this right here is an example of a volatile market where the bands are expanded. Okay, as you can see, when the market becomes more volatile, the bands widen. Okay, so these are wide bands right here. This is a volatile market. And then this is a non-volatile market on here. Okay, so all of the bands are contracted. It kind of looks like they're squeezing together, right? So this is what you'll see in a non-volatile market, and then this is what you'll see in a volatile market. Now, traders, we don't like to trade in non-volatile markets, right? Because look at the moves here. I mean, it doesn't offer very much on these moves to catch it from the lower to the from the bottom of the Bollinger Band to the middle Bollinger Band, or to try to short it from the top to Bollinger Band to the middle Bollinger Band. Doesn't really offer much moves. In the volatile market, it does. When you see when you approach overbought, it pulls back, right, until we hit this middle Bollinger Band, and then you can go in and say, all right, well, hey, we hit this middle Bollinger Band. You know, we may find support here and rally back up into the top Bollinger Band, and you know, you can get in your trade. And as you see here, you short it. Here's your short price target, and then boom, here's your bullish price target and hit. It's much easier to trade in a volatile market. That's what traders love. We love volatility. Okay. Now, one thing to go over is the squeeze. All right. The squeeze is the central concept of Bollinger Bands. When the bands come close together, constricting the moving average, it is called a squeeze. A squeeze signals a period of low volatility is considered by traders to be a potential sign of future increased volatility and possible trading opportunities. Conversely, the wider apart the bands move, the more likely the chance of a decrease in volatility and the greater the possibility of exiting a trade. However, these conditions are not trading signals. The bands give no indication when the change may take place or in which direction the price could move. And so if you look here, this is an example of a squeeze, okay? And we're looking at GameStop, all right? So as you can see here, the bands are all squeezing. And then when GameStop had that nice short squeeze, boom, the bands, I mean, look how far the bands expanded, okay? They went from being really tight here to, you know, super loose over here. So that's essentially your squeeze. Now, this is not to be mistaken with a short squeeze, right? That is something else. This is strictly a squeeze on the Bollinger Bands. And whenever you see them squeezing really hard, you don't know exactly when it's going to pop, but the Bollinger Bands are going to pop either to the upside or the downside. All right, so it's really nice to pay attention to them whenever they are squeezing, and to, you know, look a little bit deeper and try to figure out, okay, hey, well, you know, there's probably going to be a very volatile move to the upside or downside in the future. You know, let me do some analysis. Let me do some of my own research and try to figure out whether that's going to be to the upside or the downside, because a lot of times there's going to be great profits if you can catch that initial pop for out of the squeeze to when, you know, the Bollinger Bands expand. So breakouts. Approximately 90% of price action occurs between the two bands. Any breakout above or below the bands is a major event. The breakout is not a trading signal. The mistake most people make is believing that the price hitting or exceeding one of the bands is a signal to buy or sell. Breakouts provide no clue as to the direction and extent of future price movement. All right, now this is a great example here. This is a breakout, all right? And we're looking at the weekly chart right here for GameStop. But yeah, things broke out. And, you know, if you would have saw this break out and start, you know, trading up here, this is when a lot of people got caught holding the bag, right, and purchasing GME for like 300. They see it trading above the Bollinger Bands, but you don't want to enter a position when the candlesticks are outside of the Bollinger Bands. Okay, these are your two bands. You know, anytime that this happens, that a stock goes outside of the Bollinger Bands, it is going to snap back in. It is a 100% guarantee. That's how they work. So, you know, you need to be patient, right? And you need to catch the initial move, you know, before it gets out of the Bollinger Bands. And then once you're out of the Bollinger Bands, I would set a trailing stop loss or a stop loss, right? And a trailing stop loss essentially is going to be where if you're up, you know, 50%, and you set your trailing stop loss at negative 10%, a regular stop loss would have you sold out at 40, right? At negative 40% or 40% after it drops from that 10%. But if you have your trailing stop loss on and you're at 50%, and then it rallies some more, it continues rallying, and now you're up 80%, right? Your stop loss is going to trail it, and so now it's going to be minus 10% of 80%, which would be 70%, right? So you can get stopped out of the play at 70%, that's what I recommend doing when you are in a runner play or a breakout, right? Is to set a trailing stop loss. So that way you can catch some more of the bullish momentum, but you still have protection on, and you still have risk management, you know, in case things start to pull back, right? What are the limitations of the Bollinger Bands? The Bollinger Bands are not a standalone trading system. They're simply one indicator designed to provide traders with information regarding price volatility. John Bollinger suggests using them with 2 or 3 non-correlated indicators that provide more direct market signals. He believes it is crucial to use indicators based on different types of data. Some of his favored technical techniques are moving average divergence convergence. This is the MACD. On balance volume and relative strength index. This is your RSI, right? Now, this is all what I like to use as well. I like to take a look at the volume, the RSI, the MACD, the Bollinger Bands, and I like to look at one or two of the simple moving averages, right? And also I like to look at the DMI, which is going to show you guys the buyers and sellers and who's in control, right? So if you guys want to see the setup that I use with the Bollinger Bands and get the exact study set and all of the indicators, I'll have a video in the top right hand corner. You can watch that video, and that is going to basically show you guys my chart that I use for technical analysis, one of my study sets, and it's also going to show you guys how to set it up. Okay. But yeah, so because they are computed from a simple moving average, they weigh older price data the same as the most recent, meaning that new information may be diluted by outdated data. Also, the use of 20-day SMA and 2 standard deviations is a bit arbitrary and may not work for everyone in every situation. Traders should adjust their SMA and standard deviation assumptions accordingly and monitor them. And this just means that, you can go in there and you can change the Bollinger Band settings yourself, okay, on whatever indicator you're using. You can go ahead and you don't have to use the 2 standard deviations or the 20-day SMA. You can use something else, right? When using Bollinger Bands, designate the upper and lower bands as price targets, right? This is pretty nice. Yeah, that's what I like to do too as well. If the price deflects off the lower band and crosses above the 20-day average, the middle line, the upper band comes to represent the upper price target. And a strong uptrend, the price usually fluctuates between the upper band and the 20-day moving average. When that happens, a cross below the 20-day moving average warns of a trend reversal to the downside. And so what's the bottom line here? All right. While every strategy has its drawbacks, Bollinger Bands have become one of the most useful and commonly used tools in spotlighting extreme short-term prices in a security. Buying when stock prices cross below the lower Bollinger Band often help traders take advantage of oversold conditions and profit when the stock price moves back up towards the center moving average line. So yeah, I mean, that's essentially it. We'll go ahead here and we'll take a look a little bit more. But this is what they were saying, where you can use the top band as a price target, right? So, once things pull back in and that you're most likely in a bullish uptrend, you're going to bounce in between your middle band and your top band, right? So we come in, we start trading outside of it, right? So you can have your trailing stop loss on now because we're trading outside the Bollinger Bands, all right? And let's say, we come back in the Bollinger Band. Let's say you got stopped out, you got some small profits there. All right, now you're going to look for your re-entry off the middle Bollinger Band. All right, if we hold support off this middle Bollinger Band, you can re-enter, and then your next price target is going to be up here to the top of the Bollinger Band, to the top Bollinger Band. So you can come in here around $6, and you come in here, you see, okay, well, we're hitting the top Bollinger Band right around $9. I'm going to go ahead and take my profit. That's a nice 50% profit. Using the only indicator using is Bollinger Band right here. Okay, so that's kind of some examples on how to use it. And if you watch my videos, some of my videos, they will contain, I'll have a study set with just a simple moving average on there. And then I'll have a little bit more complex study with the Bollinger Bands, as I mentioned before, and the CCI, the RSI, the MACD, things like that. So thanks again for watching. Don't forget to like, comment, and subscribe. Let me know what kind of tutorials, strategies, anything like that you guys are looking for, and I'll be happy to make one for you.